There is one thing almost nobody says out loud, but almost everyone who has ever touched the stock market feels sooner or later. At some point, you start thinking, something here doesn't add up. You read the news, you watch the charts, you listen to analysts, you make what seem like logical decisions, and yet the result is either strange, painful, or simply not what was promised. And that's when a suspicion appears. Maybe the market is not what it's presented to be. Most people enter the stock market with a very simple worldview. If a company is good, its stock should go up. If the news is positive, the price should rise. If the economy is growing, investors should be making money. It sounds logical. It sounds fair. It sounds right. But the market breaks this logic over and over again. A company reports record profits, and the stock falls. Bad news comes out, and the price rises. Analysts warn about a recession, and the indexes hit new highs. From the outside, it looks either like chaos, manipulation, or a game where only insiders know the rules. In reality, the problem is not the market. The problem is what people expect the market to be. The stock market is not a place that rewards effort, and it's not a place that immediately punishes mistakes. It's an environment that constantly tests your thinking, your patience, and your ability to ignore noise. And if you misunderstand it, it will exploit that misunderstanding without mercy. Let's start with the most important myth, the one that sits at the foundation of almost every disappointment. A stock is not a company. That sounds simple, but the consequences of this idea are enormous. When you buy a stock, you are not buying the business in a literal sense. You are buying a price at which other people are currently willing to trade expectations about the future of that business. Price is not reality. Price is a consensus of assumptions. The price of a stock today is the market's answer to one question. What do we think this company will do in the future? Not what it did yesterday, but what it will do tomorrow, next year, 5 years from now. That's why past performance, by itself, guarantees almost nothing. A company may have grown for years, but if the market believes that growth will slow down, the price falls. Another company may be unprofitable, but if the market sees potential, the price rises. To a beginner, this feels unfair. In reality, it's mechanics. Imagine everyone expects a company to earn a certain amount. That expectation is already baked into the price. When earnings are released, what matters is not whether the results are good or bad in isolation. What matters is whether they are better or worse than what was already expected. And even more important, what the company says about the future. You can easily see a situation where a company beats earnings estimates, yet the stock drops because forward guidance disappoints. From a common sense perspective, this feels absurd. From the market's perspective, it makes perfect sense because prices don't move on facts, they move on changes in expectations. This is where many people get their first hard lesson. In the market, you can be right about a company and still lose money. You might correctly evaluate the product, the management, the financials. But if you misjudge how expectations will shift, the price will move against you. This is the first blow to the naive idea. I'll just find a great company. The second blow comes when people realize that the market is not a calculator. It's a crowd. People like to imagine the market as a cold, rational machine. Data goes in, models run, a fair price comes out. But in reality, those numbers are interpreted by people. And people are not rational machines. They are afraid. They are greedy. They are jealous. They want to belong. They want to avoid looking stupid. And they make decisions under emotional pressure far more often than they admit. That's why bubbles exist. That's why panic sell-offs happen. That's why prices can skyrocket without an obvious reason, or collapse without a true catastrophe. A person looks at a chart and sees the price going up. Fear of missing out kicks in. They buy, not because they calculated risk and value, but because they don't want to be left behind. Then the price drops, and fear becomes stronger than logic. They sell to stop the pain. Then the price recovers, and they buy again, at a higher price. This is not an exception. This is standard behavior. The market doesn't punish you for not knowing terminology. It punishes you for emotional reactions, and the more often you react, the more likely you are reacting at exactly the wrong time. That leads to the third uncomfortable truth. The biggest money in the market is made when you do almost nothing. This directly contradicts everything financial media loves to sell. There is constant action, signals, trades, charts, adrenaline, the feeling of control. But control is an illusion, especially in the short term. The more often you touch your portfolio, the more exposed you are to noise. And noise is the enemy of long-term results, because it forces you to think in days and weeks, while the market rewards years and decades. An investor who buys regularly and holds looks boring. But boredom is exactly what allows time and compounding to do their work. Boredom protects you from impulsive decisions. Most people underestimate how much excessive activity damages returns. Fees, taxes, timing errors, stress. It all adds up. And very often, the final result is worse than someone who simply followed a plan and stayed put. There is another trap that almost everyone falls into, and it sounds extremely smart. I'll step out when things get scary, and I'll come back when everything calms down. It sounds perfect. The problem is that the market never tells you when it's truly scary and when it's finally safe. The best days of growth often happen very close to the worst days of decline. And if you're not in the market during those moments, you lose a disproportionate share of long-term returns. People exit during downturns because they can't handle the pressure. Then they wait for confirmation that everything is fine, and when that confirmation appears, prices are already much higher. That's how the classic pattern forms. Sell low, buy high. This is not stupidity. It's human nature. But the market doesn't give discounts for human nature. Another force constantly pouring fuel on the fire is financial news. Financial media is not designed to make you wealthier. It's designed to capture your attention. And attention is captured far more easily by fear, urgency, and drama. Crash? Recession? Collapse? Last chance? These words appear not because the world is ending every week, but because they work. The problem is that your brain reacts automatically. It treats threat as a call to action, and that's exactly when you're most vulnerable to bad decisions. News creates the illusion that if you stay informed enough, you'll be able to get out in time. But the reality is that most news is either late, already priced in, or explained after the fact. Markets fall, and the news finds a reason. Markets rise, and the news finds a different reason. That's not explanation, that's narrative. When you build a strategy around news, you're building it on noise. There is one more foundational idea you need to understand if you want to stop fighting the market. In the short term, the market can be anything: chaotic, unfair, irritating. But in the long term, it reflects real economic growth, business productivity, and inflation, which slowly pushes asset prices upward. This is not a guarantee. This is not a promise that crashes won't happen. But it explains why your time horizon matters more than any forecast. If you treat the market like a game of guessing the next move, You're playing the hardest game against the strongest opponents. If you treat it as a long-term tool for capital growth, the rules change. And that brings us to another painful realization. Most geniuses lose to the indexes, not because they're stupid, but because they're human. They make mistakes, they change their minds, they react, they underestimate single company risk, and overestimate their ability to predict. An index is not a bet on one story, it's a bet on many. It reduces the impact of individual errors and emotional decisions. It's not glamorous, but it's effective. People often look for complex answers because simple ones feel suspicious. But in investing, complexity rarely means better results. More often, it means more ways to fail. Now that the overall picture is clear, it's time to talk about where most people actually start losing money in practice. Not in theory, not in complex models, but in behavior. There are several common mistakes that repeat over and over again, regardless of country, income level, or education. And the worst part is that almost all of these mistakes feel logical at the moment they are made. The first mistake is buying the hype. This happens when an asset is everywhere. It's in the news, on social media, in conversations with friends. The chart has been going up for months, and it feels like this time is different. The person buys not because they've carefully evaluated risk and long-term potential, but because they're afraid of being left out. Fear of missing out often feels stronger than fear of losing money. In that moment, the decision feels rational. In reality, it's an emotional reaction disguised as logic. The second mistake is selling in panic. When the price starts falling, the pain becomes real. Thoughts appear. What if this is just the beginning? What if I lose everything? At least I should save what's left. And the person sells to stop the discomfort. Not because their strategy changed, but because emotions took control. The third mistake is constantly checking the portfolio. The more often you look at the price, the more important it seems. A 2% daily drop starts to feel like a disaster, even though, in a long-term context, it's just noise. Constant monitoring shortens your time horizon and turns every fluctuation into a personal crisis. The fourth mistake is believing in signals, gurus, and secret indicators. It's incredibly tempting to believe that somewhere there is a formula or a person who knows more. But if someone truly and consistently beat the market, they wouldn't need to sell courses. Most experts make money not from the market, but from attention. And the more you trust them, the less responsibility you take for your own decisions. The fifth mistake is having no plan. A person buys an asset without knowing what they will do if the price falls, if it rises, or if their life situation changes. Without a plan, every situation becomes a crisis that must be resolved emotionally. All these mistakes share the same root. They appear when a person believes investing is about making the right prediction rather than maintaining the right behavior. The market does not reward intelligence. It rewards discipline. And it doesn't punish ignorance. It punishes impulsiveness. That's why the simplest strategies often turn out to be the most effective for most people. Not because they're mathematically superior, but because people can actually stick to them. Now let's get very practical. No ideology. No extremes. What should a normal person do? Someone who doesn't want to spend their entire life staring at charts, but does want their money to work? It doesn't start with investing. It starts with a reserve. An emergency fund is not a boring checklist item. It's a foundation. Without a reserve, every market fluctuation becomes a threat. If you don't have money outside your investments to cover life expenses, You're forced to sell at the worst possible moment. Not because you want to, but because you have no choice. A reserve gives you freedom. Freedom not to react. Freedom to wait. Freedom not to break your strategy because of everyday problems. The second element is consistency. Regular contributions remove the need to guess timing. You don't ask whether it's expensive or cheap right now. You simply follow the plan. During downturns, you buy more for the same amount of money. During upswings, you buy less. Over time, this smooths out your average entry price and, more importantly, calms your mind. The third element is diversification. A bet on a single story is always a high-risk bet, no matter how perfect that story seems. Diversification doesn't make you rich quickly. It makes you resilient. And resilience matters more than brilliance in a long game. But even the perfect portfolio structure won't save you if you don't have rules of behavior. The first rule is simple. Never make financial decisions under strong emotions. Fear, anger, euphoria. These are signals to pause, not to press the button. The second rule, your plan matters more than the news. News changes every day. A plan does not. If a headline makes you want to drastically change course, it's almost certainly noise. The third rule, think long-term. The longer your horizon, the less power short-term fluctuations have over you, and the less likely you are to break at the wrong moment. Many people want a secret, a formula, a better strategy. But the truth about the market is boring, and that's exactly why it's ignored. The market does not reward constant action. It rewards patience. It doesn't punish mistakes immediately. It punishes repeated behavioral errors. And the sooner you understand this, the less money you'll pay for the lesson. The stock market is not a test of intelligence. It's a test of character. It tests whether you can stay calm while everyone else panics, whether you can avoid chasing hype when it feels like everyone is getting rich, whether you can stick to your plan in moments of doubt. And that's why most people lose, not because they're unlucky,